Hi, today we are going to present about our financial management 2 assignments. We as a group 1, I would like to introduce about my group members and their responsibility. First, I'm Ives, and this is Ken, Telvin, Sudget, Martin, and also Ziel. So actually this assignment we got the scenario that an investor who got the 100,000 would like to invest in various kinds of financial instruments. Before constructing the portfolio, we have to understand his situations and also preference. So this investor actually 25 years old without insurance coverage, and so he prefers to invest in various kind of financial instruments. Also, his risk appetite is actually the balance level risk, which at the middle of conservative and also aggressive. His financial goal is actually he wants to earn for his future business set of funds. So after we understand about his personal background, we recommend the brokerage account for him to trade is actually the HLE Broking, which provides the low brokerage fees, real-time stock information analysis, and also immediate trade confirmations. The brokerage fee can as low as 8 ringgit per transactions. Apart from the internal rates, we also have to assume the external factors such as interest rates and also inflations. According to tradingeconomic.com, we actually assume the interest rate at the 3.5%, while the inflation rate is at the 2.5% by using the past data. The portfolio actually we construct is by using the 3 alternatives. First is non-marketable securities, capital market securities, and also financial derivatives.
For my part, is non-marketable financial asset, which is when you invest on it, you cannot resell in a secondary market. So fixed deposit is what I choose from non-marketable financial asset because it has a higher return than the normal saving account. So it is a safe kind of investment because it has no market interest rate risk. And fixed deposit gives us a sure return because our principal will get back at the end of maturity. For the comparison, I choose Bank Rakyat and Public Bank. Bank Rakyat give 4.5% of interest rate, while Public Bank only 3.6% of interest rate. And the interest rate for the Bank Rakyat is fixed, and Public Bank may vary if there is a change in overnight rate policy. For the risk and return, there is a risk in fixed deposit. First is the inflation risk. If the inflation rate is higher than the interest rate, we actually making loss in terms of real interest rate. For the currency risk, at the end of maturity, when we get back the principal, we may make loss if our currency is depreciated. For the return, we may make interest rate return while earn a simple return in the fixed deposit. How to minimize the risk? We can try to do more research on the consumer pricing index and producer pricing index to determine the future inflation rate. And we can also divide our principal to invest other financial assets if the fixed deposit rate is under normal interest rate. So this is the expected maximum profit and loss for fixed deposit. So we investing 15.2% of our capital into the Bank Rakyat fixed deposit, and we will get back 15,684 at the end of the maturity.
Our second non-marketable financial asset investment is life insurance. It is a financial contract between an insurance company and a policyholder. The purpose is to provide financial protection to surviving dependents after the demise of an insured. The insured agrees to pay a premium, and the insurer agrees to pay a sum of money upon the death of the insured. The first risk is underwriting risk. It relates to losses on an underwriting activity generated either by the inaccurate assessment of the risk insured or by unforeseen circumstances that is out of an insurer's control. Within underwriting risk, it also includes biometric, policyholder behavior, and expense risk. The second risk is market risk. It is due to the mismatches between assets and liabilities. As insurers are also investors, they are inevitably subject to a certain degree of market risk, emerging primarily from asset price fluctuations. Another risk is liquidity risk. It arises due to unexpected policy cancellations and working capital needs. The types of life insurance products can affect liquidity risk exposure. Products that have surrender value will pose a higher level of risk compared to those that do not have. For return, the kind of return we can say is the tax benefit. It is generally non-taxable and premiums paid made eligible for tax relief. We can minimize risk through diversification. For underwriting risk, the consequences of which can be mitigated by reinsurance. It diversifies well in sufficiently large homogeneous portfolios. For market risk, the insurer should engage in investments that are uncorrelated to a sufficient degree. For liquidity, and effective liquidity risk management can be started at assessment of liquidity characteristics of the insured's assets and liabilities. Monitor regularly to ensure sufficient liquidity needs and assets can be liquidated fast enough to replace short-term funds. The reason we choose this plan is because there are various types of benefits provided, such as death benefit, total and permanent disability benefit, accidental death benefit, medical benefit, and many more with an affordable premium.
So the second alternative in our portfolio is capital market securities, and I was assigned to do the bond markets. Bond is actually a debt securities that we bought the company debentures and also claim the coupon payments and also the maturity payments. According to the article that found out from the Edge markets, the Malaysia bond market is actually one of the best markets amongst all the emerging economies. The reason we choose bond in the portfolio is actually we want to diversify the risk in invest into the stocks and also derivatives. So this is the 3 selected bonds that we include in this portfolio, and I will show few of the calculations that make me decide to select these 3 bonds. Like I calculate for yield to maturity and also the MPV. Okay, so this is the second one, and also this is the third bond, which is a government bond. Now I would like to identify the risk of investing in bond and also the returns. The first risk is the credit risk. The credit risk is the probability that the company unable to pay off the debts and also will dissolve in the bankrupt. And the second one, the interest rate risk, is the government set risk, actually do definitely affect the bond pricing. I would like to present about the returns on bonds that actually in the 2 forms. First is the coupon payments and also principal payment during the maturity, which is the maturity payments that you also can call the bonds before the maturity, which we call as the callable bonds. How to minimize the risk while maximize the return in investing in bonds? So the first is diversifications. Actually, we're using the different terms of bonds to actually diversify the risk. And so second one is access to the credit rating from the professional rating agency such as RIM and also MRC. Okay, as you can see, this is the reason we choose these 3 bonds in our portfolio. First, the MP will actually higher than the market price, which represents that the market price actually undervalues the bonds. And the second one, the credit ratings from the professional rating agency. The first one is actually AA from the MRC, and the second one is the A1 from the RIMs, and the last one is the government bond, which refer as the risk-free rates.
For my part, I will be talking about stocks. Stocks is the purchase of ownership of a particular company that gives dividend. There are 2 types of stock, common stock and preferred stock. Both also give dividend, but the common stock have the rights to vote during the shareholder meetings. For our portfolio, we have selected Bursa Malaysia, Sunway and Tonghe Resource. The reason we choose Bursa Malaysia is because it is a much more stable compared to other stocks, and it also have a strong foundation. We choose this instead of same sector of stocks such as Hong Leong and Public Bank is because we are aiming for a higher return. Next, we choose Sunway Berhad is because they gives a potential or a special or extra dividend which could increase the return for our investor. We choose this instead of Hap Seng Berjaya Group is because we have the bond side to diversify the risk. And the last one, Tonghe Resource Berhad, is because they have a high return. Also, they have a P ratio of 10.53 and an ROE of 42.01%. We are aiming for high return, so we are choosing this stock instead of Hap Seng or Berjaya Group. Next, we will talk about the risk and return. For the risk of a stock, we have economic risk, transaction cost, and inflation risk. For economic risk is such as when the market plummet, such as the 2008 subprime mortgage.
Next, we have transaction cost is the service charge from the brokerage. And then we have inflation risk. The inflation risk occurs when the inflation exceeds the return from the stocks. For the return, we have nominal return, return of equity, and return of capital. For nominal return is the return you get when the stocks are sold. For return of equity is the income for the company and potentially becoming the dividend of shareholders. For return of capital is the rise or drop of the share price. Lastly, how do we minimize the risk and maximize the return? The economic risk, we can maximize the return and minimize the risk by fundamental analysis, by knowing how the company is doing. For the inflation risk, it is basically impossible because we are choosing all the high return stocks. And lastly, for the transaction cost, we are choosing Hong Leong e-broking, which provides a low transaction cost, which we are not going to have a transaction cost problem.
For the derivative security, we will choose to invest in a future contract. Future contract is a kind of the paper agreement which two parties agree to trade the particular assets in a specific quantity, price, and depth. And normally the future contract will be used for hedging and also the speculation. So the future contract we choose to invest is the crude palm oil future. But why don't we choose to invest in the BND USD crude palm oil future or the BND gold future? Because the crude palm oil future is traded in the Malaysian ringgit, so our investor will not involve in the currency risk. And the agriculture sector is always play the important roles in the Malaysian economy, and it's also the main GDP contributor, which contribute 43.1% of the GDP of Malaysia in 2016. So we believe in its potential and opportunity to grow. For the risk and the return, the risk that involved in the future contract is leverage risk and also the risk of unlimited liability. So for the leverage risk, the leverage effect in the future trading can be explained by use only a little amount of money to trade a huge amount of investment. So which also means when the underlying asset price fall only by 10%, the initial margin you will lose is around 100%. And the second risk is the risk of unlimited liability. So the losses will be accumulated as long as the price keeps moving downward. So the investor will not only lose the initial margin, it will also turn out with a lot of liability. So for the return, it's like the long future and the short future. It's like depends on the price expectation of the investor. If the investor expect the price will go up, then the investor will choose to buy the contract. If the price will expect to go down, they will sell the contract. So how to minimize the risk to maximize the return? The investor have to know the leverage and also can use the correct position sizing. The correct position sizing is like a method to determine how many contracts the investor to buy. Also, they have to understand the market before they start to trade. Like they have to know the risk behind the market and the maximum profit they can earn. So is it worth for they take the risk? And also the investor have to know the timing to leave and to trade their contract.
Since we have decided to trade in the FCPO, we have to identify its requirement and also how does it work. The requirement of the FCPO in its initial margin is 5,000 ringgit. And also the minimum contract the investor must hold is one contract, equivalent to 25 metric tons of crude palm oil. So why the future contract always defines as high risk and high return? Because of its leverage effect. The total value of the transaction is 50,000 ringgit. Because the current market price is 2,000 ringgit, and also with minimum contract size is 25 tons. And also we can use 5,000 ringgit to trade this 50,000 transaction. So the leverage effect is about 10 times. How does the future crude palm oil actually works? So whenever there is a 1% movement in the market price, you can make a 500 of profit or losses if the current market price is 2,000 ringgit. If the investor is expecting the long future and also the future market price is actually going up, so you can make the profit of 500 ringgit. If you expect it goes up but it actually fall, so you will make a losses of 500 ringgit also. So since we got the 10k in this portfolio of money, so what strategy we will use? Is we expecting the price to fall or we expecting the price to goes up? So our strategy is short future strategy. Is we going to sell, we're expecting it to fall. Because why? The demand from the international market such as China and also the India is actually decreasing because the renminbi and also the rupee is actually depreciating. So their import costs will increase. And also the main reason is the stock level as compared to the 2017 is high. So in the consideration of high supply and also the low demand, so we expecting the price to fall. So we go for the short future strategy. So we also expect the price that we will earn from this transaction by using the average 6 months highest minus the lowest price. So the daily fluctuation price is around 18 ringgit. So approximately daily we will gain 445 ringgit. So in the conclusion, the required rate of return in our investment is quite low. So in the result, the WACC is also low. This can consider as our investment is lower risk. And also the total return that we could expect from this 100k of investment is 17,600 ringgit. Thank you so much for watching this video.